Broadcast.
We are online now.
Good morning, students. Welcome you all to the webinar series organized by AAT Sri Lanka. Today, I'll be taking you all through one of the important topics of financial reporting, that is consolidation. Without taking much of your time, let me have the pleasure of inviting Mr. Mohammed Nasir to continue his presentation. Mr. Nasir is a senior member of AAT Sri Lanka. Also, he possesses the memberships of C Sri Lanka and CIMA. Also, he's a past finalist of ACCA. He holds a master's in financial economics at University of Colombo. And importantly, he's lecturing AAT students for many years. Dear students, stay with us till the end of the presentation and make use of this opportunity. Dear sir, over to you.
Thank you, Chamil. Right. I hope the screen is shared among my students. Right. Right. Okay. So, students, what we are going to do on this topic, we are going to, because in the examination context, you will be asked to prepare consolidated financial statement. So it can be a P&L or it can be the balance sheet in simple form or statement of financial position, right? So what we are going to do is it's a bit of a deeper topic, which is around 20% marks, right? So what you are going to do is we are going to do in a segment basis, right? So today we will be doing something like an introduction part. It is the financial statement, right? So the topic for the day is Consolidated Statement of Financial Position, Part 1. So I will show you my agenda, right, for the day. So what we are going to discuss, the introduction part of it. In introduction part, we are going to discuss about the standards, what we need to look into, and the key definitions, right? And we will be doing a step-by-step basis process. Might be the step-by-step process I will take you through around. For today, I'll be taking you through around 7 steps. Might be in the later in the future, if we continue, what we will do is we'll take you through the rest of the process. So almost the objective of this idea is to understand the basic consolidation part of it, right? So step number 1, how we are going to adjust the investment by the parent in the subsidiary. Step number 2, if there is a goodwill, how we are going to adjust for the goodwill. So step number 3, if there is gain on bargain purchases, GBP, how we are going to adjust. And if subsidiary has profits in the form of pre-profit or post-profit, how we are going to adjust this pre-post profit and reserve. And if subsidiary is a partially owned subsidiary, how we are going to adjust for the remaining part, which is called control, right? And finally, And finally, we are going to discuss about impairment of we are going to say, step number 6, we are going to discuss about the impairment of goodwill. There are 2 methods in NCI. So we'll see how these methods will affect the goodwill and the impairment thereon, right? Finally, if there is any intercompany receivable and payable, how we are going to adjust it. So this is a very basic model, what we are going to discuss, students, right? So you will be able to have a very basic balance sheet to be done, right? So might be as a percentage of your exam, you will be able to, if it is 20%, you will be covering around 8% of the adjustments, right? Okay, now we'll go into the discussion. So we'll start on with consolidation accounts are governed by 3 standards, right? We might not be having every standard in a detailed format, but we will have a very basic format. So the first standard is SLFRS 3, which talks about business combination. So if you buy a company, at the time of buying the company, how we are going to do the consolidation process, right? So we will just understand the basic requirement on the SLFRS 3. The main standard which discuss how you prepare consolidated financial statement is SLFRS 10. This gives you the guideline, what are the procedures you need to do to prepare the consolidated account. So I am just stressing, this is a very basic way of discussing the adjustment. So we'll understand the basic steps, the method, the procedures prescribed in SLFRS 10. Finally, there is another standard, SLFRS 12, which discuss about disclosures in those of the entities. So disclosure standard we can set aside for the time being. So we'll understand SLFRS 3 at the time of buying, what kind of an accounting treatment we need to apply. And after that, how we prepare consolidated accounts for the company. So we will be focusing purely on SLFRS 3 and SLFRS 10 student, right? Now, after we give an idea about the standards, we need to know the key definitions in SLFRS 3, right? So the first key definition in SLFRS 3 is business combination. What is a business combination mean? In consolidation aspect, a company called A goes and buy a company called B. So that is the definition, right? So I have given you the business combination definition in very simple format from the standard. A transaction or other event which the acquirer, in our context the parent, goes and obtain the control of a business, might be in our context the subsidiary company. If parent goes and have a control by the control of the subsidiary company, that is called the business combination, right? So I have given a parent company, you can see. So parent is the person. So we are here, the definition says as acquirer. In our context, it's the parent. So who is a parent? Like acquirer in the context, the entity that obtain control of an acquiree, right? So that main person A will go and buy B. So the A will be the acquirer, right? Then you can see there is another company. I have put an arrow, the acquiree, right? So acquiree is the business that the acquirer obtain control, right? So in our context, you will have 2 companies, A company and B company. So A will be the parent company, B will be the subsidiary company, A will go and buy the B company, right? Now, the standard gives you a definition on a business, right? So we talk about a business, but in our context, we can talk about a company because we are talking about a simple level, right? So what is a business? A business is an integrated set of activities or assets, which is capable of generating some income in the form of dividend or in the form of interest or something like that. So generally, if you see a business will have input, process, output. So in our context, we are not going in very detail of the business definition. What we are understanding is if A goes and buy a company called B, B is having a business. So we will be in simpler format, understand that is a business combination. The main element in the consolidated account, student, is the word called control, right? The acquirer obtained the control of the acquirer. That is the definition, right? So what is control? It is a power to effect relevant activities which expose the parent company to variable return. I have given some keywords, right? Might be the power, relevant activities which expose to variable return. Might be you need to see if parent company goes and buy a subsidiary company, whether they can demonstrate the control. I have given some examples so you can see later, but for the time being, you got the point, right? So this is the thing called business combination. So in a business combination, you will see a parent company, you will see a subsidiary company, my dear students, right? Now we'll go to the next definition, right? You wonder, a parent company can have as many as subsidiary company, right? If you take the group of companies in Sri Lanka, parent company will have 100 companies, 40 companies, 60 companies. But in our examination context, we will have a parent and one subsidiary company. That is the key point, right? So you will be later, when you study further things, you will understand there are a lot of aspects. But in our exam, that's what I have given some kind of a subsidiary lifted. So parent, in our exam, we will have one subsidiary company, my dear student. So I have given you a basic understanding of what is business combination, right? We'll go to the next definition, right? So after knowing the business combination, the key definition you need to understand who is the person at the top and who are the people at the down, right? Now this combination, the arrow, the person who's at the top and the person who has the down or bottom is called as a group of companies. Right? It's a group of company. What is the group of company? Group of company is the parent and all of its their subsidiaries, right? So that's what I have given. The parent company and all of the subsidiary company will fall into the concept of group. These definitions are tested in the exam. Please focus on that, right? Now you will ask, who is the parent on the top? So the parent is an entity who control one or more other entities who are down, right? Maybe in our examination format, in a simplest format, we can say parent is an entity, right, who's on the top, A company. Subsidiary is a company who's on the bottom, is a B company. A company control B company, right? So that is the company called who control is known as what? The parent company, right? Now you can see the next definition. Who is a subsidiary? The entity that is controlled by another entity. So obviously the parent is a person who is controlling, subsidiary is a company who get control. This combination of arrangement is known as group of companies, my dear students. Clear? So these are the key definitions or take home things from these two standards, right? Now, after understanding the basic definitions, right, we need to understand what are the guidelines given in SLFRS 3 for you to do the business combination, because this will carry step number 1 to step number 5 more or less, right? So you can see students, right, I have given the control part of it here in very detailed format. So a control of an investee, right? See, control means an investor control an investee. Investor mean the parent company, investee mean the subsidiary company, right? Okay, an investor control investee when the investor is exposed or has the right, right? So generally you will buy the ordinary shares for you to demonstrate the right over the company to variable return, right? To the variable return. Generally, if you buy a company, you will have dividends, right? Variable return from the involvement with the investee, right? Generally, when you buy the ordinary shares of the company, you will be able to put board of directors. So that is your involvement and ability to affect those returns through your power, right? So generally, if the parent company buys a subsidiary company, we said there is a control. Why? You buy the ordinary shares of that company. Therefore, you can participate in the decision making and you can improve the operation. You have a variable return. That is very important. What is variable return? Generally in the form of dividends or any cost saving as a benefit, what you get, right? So keeping this definition in mind, because we will evaluate through these definitions when you come to the next slides as well, right? Now, as I said, SLFRS, the guidelines in SLFRS 3, how to prepare business combination or consolidation first step, right? So SLFRS 3 requires you to apply what method? The acquisition method. It's a very simple format. You need to identify first one called an acquirer, right? Acquirer in your exam, very simple format, the parent company. You don't need to worry about it because you will be given A will be buying B company, right? And right, so you will be having an acquiring, right? You will be having an acquiring. You know what is the company, you will have the control, right? The important thing is what? You need to determine the acquisition date. In your examination, the examiner will give A Limited bought the B Limited on 1st January 2019. You need to know all of this, right? And these are the step 1, 2, 3. But step number 1 and step number 2 you can combine together, but I have given for your evaluation separately. So you need to identify the acquirer, you need to identify the acquiring, and you need to determine on what date we bought the subsidiary company. After that, you need to understand what are the values of assets and liabilities in the subsidiary company. right? Generally, the standard says you need to take the fair value. These adjustments we will look into later, but we will take the book value of assets and liabilities for the time being. You need to determine that, right? Sometimes you will buy a company not at 100%. You will buy at 80%, right? Don't worry, we will see some questions how you do that. If you buy lesser than 100%, the other remaining percentage owner is known as non-controlling interest. You need to determine the non-controlling interest. So these are the 5 steps, right, which you will do at the beginning of the consolidation. Identify the acquiree, identify the acquiree, determine the acquisition day, find out the assets and liability, determine the NCI. Now, once you have done everything, the 6th step, what you need to do is you need to compare the price what you paid, and you need to compare the business value of the subsidiary, right? Sometimes you will pay more or less, right? For example, a business worth 100 million, you will pay 120 million, or you might pay 100 million, or you may pay 80 million. So if you pay more or less, how we account the difference is the determination of goodwill or gain on bargain purchase, right? So in the examination context, you will be given some information to understand A is buying from B, right? A is buying B, and how we can determine the goodwill component of it. Clear? So that is what evolves with business combination, right? There are other accounting requirements, but we are not going in very detail. So at our level, this will be sufficient enough to understand how these things happens with. Okay. Now, when you go to the next one is SLFRS 10, which talks after you do business combination. What are the things you need to do to prepare the consolidated account? After you do business combination, what you need to do additionally to prepare the consolidated account? So you can see the step. First step, very important. Combine the assets and liabilities of parent and subsidiary. Parent assets are there, subsidiaries assets are there. You need to combine it and present. Parent liabilities are there, subsidiary liabilities are there. You need to combine and present. So this is the one accounting treatment or accounting method which is explained by consolidation standard, right? After you know that, there is another small point which I explained from SLFRS 3. What do you need to do? You need to take the parent investment, compare with the equity in the subsidiary company. So what you can do is you can determine goodwill or GBP, right? So we will see these are the procedures which I have explained. What we will do is we'll understand how we are going to do in the accounting form, right? Next one, if there is any intra-company assets and liabilities, right? That means parent is given to subsidiary or subsidiary is given to parent, vice versa, right? So if these things happen, how we can adjust these amounts? So why I have underlined these 3 points? Because these 3 points are the things what we are going to discuss over the period, right? On top of that, the standard gives you some guidelines how to account for intercompany unrealized profits or loss, and if there is a losses, how to treat it. So these things, even though these are the procedures, we might go into part number 2 to discuss about these things, right? Now students, so you know business combination gives guideline to determine the goodwill. SLFRS 10 tell you what are the procedures you need to adapt to prepare the consolidated account, right? The main important thing, how you establish control, right? How you establish control. Generally in examination, if you buy more than 50% voting right? That means generally ordinary shares. So if you buy more than 50% of voting right, you can establish control in the subsidiary company. I want to repeat again the definition. I explain you. Control is the power where you can affect the relevant activities which expose to variable return through your involvement. So if you become the owner or the shareholder of a subsidiary company, more than 50%, you establish the control. Why? You being the shareholder, you can appoint majority of board of directors. Those directors will take the decision which are more relevant for you. You will take the decision which are viable for you. That might be said as involvement. Through the involvement, you will get the variable return. Either you get a profit or you might incur a loss. So profit will be redistributed as dividend. So keep in mind, generally the dividends are variable. So therefore, if you buy the shares of a subsidiary company, generally you will be able to have the control. Important thing is more than 50% in our exam. But alternatively, student, there are alternative ways. You can achieve the control through an agreement, or you can have an authority to appoint majority of board of directors. This will give you alternative ways of achieving the control. But in our exam, what we are focusing is only we are going to talk about parent is buying more than 50% shares, right? But in practical purpose, per parent can buy lesser than 50% shares, but still they can show the controlling part of it. These items we have excluded from your discussion. Why? These might not be relevant in our examination context, right? So if you see a parent company goes and buys 60% of shares, you can say there is a business combination. Once you have done the accounting for business combination, next thing you need to say how to prepare the consolidated accounts, right? Now, as I explain every aspect of it, right? Now see, you will ask, we are preparing individual accounts of A and B. Why we need to prepare another consolidated account? There is a problem like that, right? So that the question you raise, why we need to prepare a consolidated account? That is the question you raise, right? So you say, okay, I have A limited, I have B limited. Why can't I go through? No. Why? Because you understand there is an ultimate shareholder who has given money to the parent company. Parent company has redistributed this investment to subsidiary company. If you are not preparing consolidated accounts, the ultimate shareholder will not have holistic view of the group, right? Holistic view of the group. So to understand the holistic view of the group, you need to prepare the consolidated account. See, parent company is there, subsidiary companies are there, right? Okay. Okay. So you need to understand the holistic view of every company, right? So therefore, what you do is you take all their financial statement, combine and prepare consolidated financial statement, right? Now, I will emphasize further why you need to prepare this consolidated account. Think about if your subsidiaries are loss making, right? Your parent is profit making, subsidiaries are loss making. If subsidiaries are loss making, then there will be a problem. Why? You see parents account and say parents makes profits, right? Generally the parent company in the practical world is a holding company who get dividends, right? They are making profit, but your subsidiary companies are incurring losses, right? So if you don't put everything into the same concept, right, keep in mind, you will not understand the realistic picture. This is why, for your understanding purpose, we prepare the consolidated accounts, right? So keep in mind, the question comes, can we see the consolidated business, right? Is there any business we can say? Keep in mind, you have the companies as a legal entities, right? A, B, C. If I say this company is A, B, C, these are legal entities. But the consolidated A group is an economic unit, what we make. It's a hypothetical economic unit which combine all of these. So if you say about the group is a combination of every business, right? So I hope you understand how we prepare the consolidated accounts and the reason for the consolidated accounts and what are the rationale of the consolidated account. Another normal point, right? Now you will have a next question, sir. After doing all this stuff, where we record these adjustments, the accounting treatment, where we record? Keep in mind, we neither record in parent, we no record in subsidiary. We adjust all the adjustment in the consolidated financial statement, right, students? So to recap what we did, we understood what is a business combination, who is a parent, who is a subsidiary, who is a group, and business combination says what? 6 steps: identify the parent, identify the subsidiary, determine the purchase date, and see the assets and liabilities and non-controlling interest, determine goodwill or GBP. What the consolidation standard says, take the assets and liabilities of parent and subsidiary, remove the intercompanies, and prepare the holistic view of consolidated accounts. Clear? So therefore, these adjustments, what we are going to do is, we are going to do with the consolidated accounts, right? So this is the background on which how you prepare consolidated accounts. Now we will start on with question number 1, right? Now we are going to discuss step number 1. What we do with the parent's investment with the net assets in subsidiary. I use the word called fair value, right? Because the standard want you to take the fair value. But in this sum, the book value was equal to fair value. Right now, you can see there is a PPE of parent subsidiary. What is the procedure? Like assets and liabilities added together and presented. That is the step number 1, right? Okay, PPE of the parent subsidiary. See, investment in B. So the standard says whatever the investment made by the parent should be eliminated against net assets in subsidiary company. If you see the net assets in subsidiary company, go to the subsidiary company, you can see their net assets generally represent stated capital and retained earnings. No retained earnings in subsidiary company. That means their stated capital is the only amount they have as a net, right? So you can see current asset 3,000, 5,000, the balance sheet balances. Stated capital 15,000 and 7,000, retained earnings 3,000, 0, liabilities 2,000, 3,000, right? So total balance sheet balances, right? Now I have given the question. See, A incorporated B and acquired their 100% shares, right? You need to prepare the consolidated account. Assumption we made, there is no profit in B Limited, right? So for easiness, we said there is no profit in B Limited. So you know the step number 1 is what? You need to eliminate investment made by the parent against the net assets in subsidiary company. Okay, that is the first step, right? Then like figures will be added together and presented as it is from one entity, right? Okay, now we'll go to the answer and see how we have prepared, right? So there will be a cross casting. See, arrow comes, investment made by the parent, remove the net assets in subsidiary company, knocked off. So the balance procedure will be what kind of a procedure? Line by line procedure, student. Parent is 10,000, subsidiary is 5,000, consolidated is 15,000. Investment knocked off. Current assets 3,000, 5,000, 8,000. 15 and 8 will be 23,000, right? You need to add on a horizontal basis rather than the vertical basis because we do this kind of an elimination, students, right? So we do this elimination. So therefore you can't add it on a vertical basis, but better to add it on horizontal basis. Clear? So that you got the answer. And keep in mind always the stated capital will represent from the parent company. Why? Because we have given money to the parent. Parent has redistributed to other person. So therefore, easy step for you to understand, capital is only from the parent company, right? So you can see the 15,000 capital represent as it is 15,000. Okay. Retained earnings 3,000. Why no subsidiary? And liabilities 2,000, 3,000. So it is 5,000. So it is 23,000 students, right? So what is the first step? It's very clear, right? What you did? Remove the investment against the net assets. Balance will be what? Consolidation, line by line additions, right? Now you will ask the next question, which is a bit of an which of a variation. If subsidiary has other investments, right? Student, keep in mind, in our exam, we have only one subsidiary. So other investment, we might not be applying any accounting treatment at our context, right? So what the consolidation says, investment made by the parent should be netted off against net assets in subsidiary, right? The balance item, what you need to do is add line by line. Now you can see in our exam, we will only have one subsidiary. So the consolidation applicable for one company, the subsidiary company. Clear? Right. After eliminating investment made by the parent, remaining investment or any investment made by subsidiary in other companies should be presented in a line by line addition as a single entity. So what you need to do is go to the parent investment, go to the subsidiary investment, add it, but remove the investment made in subsidiary company by the parent, right? So I have given the formula, you can see as an example, total investment in the parent's books, total investment in subsidiary books, investment made by the parent in subsidiary. You need to remove that because only the consolidation applicable for that part, right? So therefore you have investment in the consolidated accounts. So keep in mind. So if in the examination, if the examiner gives you a higher amount of investment, you need to remove only the parent's investment in subsidiary. Remain investment will be kept as it is, right? Now I have given a question where you can see the question. See step number 1, a small variation. Eliminate the investment with other investments, right? Okay. Now see, as my step, I have taken the same balance sheet. Why? You can understand how these balance sheet change with one by one adjustment from step number 1 to step number 7. So it is for an easy understanding that you can understand the steps and the variation. So I maintain a uniformity in taking this balance sheet, right? So that is the objective. Rather understanding the line by line, the objective is to understand the adjustment, how it affects the same balance sheet together, right? So see, same, right? You have the PPE, right? Here the investment is 15,000. So that means I have given investment in companies, B and others. So keep in mind, only we adjust B company only. We let the rest as it is, right? Current assets, the same figure, 3 and 5. So the total comes up here in this case 28. They are in this case the same 10. Stated capital 23 and 7. Retained earnings 3, liabilities 2 and 3, 28 and 10, right? So you can see now how it comes the adjustment. A incorporated B with 7,000. So students, now you understand, out of 15,000, you need to adjust only 7,000. So there can be other investment which represent how much? 8,000. Here I maintain another adjustment saying that no profit in subsidiary because of the simplicity, right? Now you can go to the answer. Answer comes right. I have given in a very detailed form, so you can see right now. See how this adjustment evolves here, right? See, investment in others, that is the very key point. Parent is 15, sorry, the total parent had a 15, but investment in subsidiary company 7, therefore the rest is 8. Subsidiary has 0, therefore it remains as 8. Right? That is the first thing you need to do. Take the total investment, remove investment in subsidiary company. Only the consolidation applicable for that. Now you can see my arrow will come. Only knock it off. Investment made in B compared with net assets in B. Right? Okay. So only that is the adjustment you need to do. Right? Okay. So now you can see. Hurry. Now you can see consolidated PP is 15. Investment in other companies, same technique, 8. But investment made in parent, investment made by parent in subsidiary, eliminate, right? Against the net asset in subsidiary. Okay. Current assets 8. So you can have vertically the total. The vertical total will be 23,000. Okay. Always add it like this because that is the way, because in between you have eliminated some figures. And I said always, right? Always the net assets, the stated capital will remain from the parent company. Stated capital remained as it is from the parent company, stood at 23, right? Retained earning 3,000 and the liabilities will be 5,000. So the total will be 31,000, right? So 15, 8, 23, right? Another 8 will be 31, right? So here the stated capital is 3, retained earning, so stated capital is 23, retained earning is 3, 26, another 5 will be 31,000. So what we did, we removed the parent investment against subsidiaries net assets. Only that is the step we did. The balance will be line by line consolidation. That is what I want to give the business combination. What we did, take the parent investment, match with the net asset in subsidiary. That is what comes from the business combination. Balance is line by line consolidation. That comes from SLFRS. Clear, my dear students? Right. Now you have understood how we can adjust investment made by the parent in the net assets in subsidiary. Okay. Now you will ask, if investment is more or less, now in this sum I have given the same investment. If investment is more or less, what is the step? What is the procedure we need to do? Right. Now we'll go to the next example. Step number 2. Investment is more or less. How we are going to do? Right. Now see first one. If investment equal to the net assets, No adjustment. What we did, we eliminated and we didn't do anything, right? Now, the second one, if investment is greater than the net asset, see, investment is 150, net asset is only 100. What we do with the 50? The 50 balance is the excess price you paid. The standard gives you a name, goodwill. The standard gives you a name, goodwill, right? As per the standard, this goodwill to be recognized as intangible assets, as this goodwill should be recognized as intangible assets, right? So sometimes you tend to buy a business at a higher price expecting a potential benefit. That potential benefit is the goodwill in simplest form, right? Now you might ask, sir, okay, sometime I buy a company at a higher price. If I buy a company at a lower price where the company is not performing, it's at a very low price to sell. If I buy at a lower price, yes, possible. If you buy a company, investment by parent is 80, but the net asset is 100, that is a deal for you. That is a profit for you. So the standard says the difference is GBP, right? Gain on bargain purchases. It is the profits, right? We are not going in detail in the problems in getting this GBP because there are a lot of guidelines in getting the GBP. We are not going into detail, but in your exam, if you ensure that your calculation is accurate, right, either you can get a goodwill or you can get a GBP in the examination context. So we are not going in detail to understand the gravity of it and requirement. So in simplest form, when you compare the investment of parent with the subsidiary, you have three options. No impact, there is a higher price, which is a goodwill. There is a lower price, this is the profit, right? Okay. Now we'll see if the goodwill comes, how we are going to incorporate, right? So investment by parent is 150, net asset is 100. So therefore the excess is the goodwill 50,000. Okay, goodwill 50, right? So the standard says goodwill is an intangible asset. See the word underline in the consolidated FS, in the consolidated account. So you can't have in the parent, you can't have in the subsidiary. It is in the consolidated account. So goodwill is subject to impairment test annually in accordance with LKS 37. Later we will discuss about how we allocate the impairment. In the consolidated accounts, you will not be asked to in detail analyze the impairment, even though it's in the syllabus, might be separately tested. So you will be given an amount of impairment and you need to ask how to account for it. But in this slide, very important thing is, if you feel a difference, excess, that excess is the goodwill, right? So that you need to record that in your balance sheet, in the consolidated balance sheet, as an asset, as an intangible asset specific, right? Now, next slide I have given how to calculate a goodwill, right? Now, this format is a very comprehensive format of calculating, right? We might not be using every aspect of it, right? You can see investment made by the parent, right? We ignore this for the time being because if it becomes a partially owned subsidiary, in our examples, it's a fully owned subsidiary. That is the definition we said. We said the subsidiaries were incorporated, right? Okay. By the parent, right? So if it is a partially owned subsidiary, how you take it up, the total, and compared with your net assets. And we have not gone into pre-profits, pre-reserves or anything, but in a simplest form, you need to take the investment made by the parent, compare with the net assets in subsidiary. So you need to find whether it's an excess or a shortfall. Excess means an asset, that shortfall is the profit for the parent, right? So I have highlighted again here, we are not going to discuss NCI or any profit here. The objective of this slide is to get the goodwill, right? So you take the investment, compare with the net asset in simplest format and see how it evolved, right? So now you can see the next diagram question, right? Next question, right? So you can see the same balance sheet is given. That's why more or less the same balance sheet is given. PPE, investment in other companies, current assets, stated capital, retained earning, and liabilities. In you have the totals. Now see how it evolves, the adjustment. A acquired B by investing 10,000, right? Now your net asset is 7,000. Investment is 10,000, right? 10,000 and own 100% of shares, right? 100% of shares. And your SFEs are given on that date and you are required 31st December. right? And you are required to prepare the consolidated accounts. For simplicity, no profits in subsidiary company. So it's very simplest form, right? It's a very simplest form, right? Now, you can see how I'm going to do. I'm going to do a very simplest format here, the answer, right? Now I have populated all the stuff accordingly. I took the investment, right? I took the PPE. I took the investment here separately. See, the parent has an investment of 15, but the investment in subsidiary is 10,000. So therefore, other investment is 5,000, right? So investment in B is therefore 10,000. Okay. So I have done the small segregation of it, right? 15,000 I split it into parent how much, other investment how much, parent investment how much. Okay, students. Now see how we are going to knock it off. Right. The investment made by the parent is 10, net asset is 7. Therefore, there is a difference. Therefore, there is a difference. What is the difference? That difference is the goodwill comes here. See, 10,000 minus 7,000. Therefore, there is a goodwill of 3,000. So what you did, compare the investment with the net assets. Investment is 10,000, net asset is 7,000. There is a remaining amount of goodwill 3,000. Okay, so the balance consolidation will be the same. 15,000 PPE, investment 5,000, right? Investment in subsidiary gone. Why it's gone? It has taken for the matching purpose. But a new caption item, goodwill comes. Why? Investment is 10,000, net asset is 7,000, so 3,000 is goodwill, right? And you have current assets. I said stated capital always comes from the parent company, retained earnings, liabilities. So what is the variation here? The same example, earlier we had 7,000. Now we are investing 10,000. So the 10,000 belongs as goodwill, right? Now we'll go to the next step. Step number 3. If you give something lesser, right? If you give something lesser, the lesser is known as gain on bargain purchases, right? You can see the gain on bargain purchases. Investment made by the parent is 80. Net asset is 100. So you have a deal, a profit. So the difference is the profit on the business combination. What the standard says, right? The gain on bargain purchases should be recorded as a profit in the consolidated financial statement. Specifically, this is the profit attributable to parent. Why? Parent company goes and buy the subsidiary. Parent company goes and buy the company. So therefore, it's a profit for them, right? Therefore, it should be added to consolidated retained earnings. What is this consolidated retained earnings? This is the total amount of profit earned and the share of profit taken from the subsidiary company, right? So we will go in further to see how this consolidated retained earning is done. See, consolidated retained earning is the parent's profit, share of subsidiary profit, right? You need to add to the parent's profit in simplest form. So if you find any GBP, please add to the parent's profits, right? Because why? Parent company goes and buy the subsidiary company. Same example, we'll go for another small variation, right? Same balance sheet is given, right? Okay, so I'm not going to repeat the balance sheet as the same balance sheet. You can see the adjustment. Now, A acquired B by investing here. How much? 5,000. Earlier 10,000, now 5,000, right? On 1st January, and the balance sheets were given. Assume no profits, right? So you have acquired at the opening date, your closing date balance sheet is given. Company was not having profit. So how you are going to do that? Right now, earlier you understood we paid 10,000 compared to 7,000. Now we are paying 5,000 compared to 7,000. See, I have given the balance sheet in a simplified form, right? Now I say PPE is explained. Investment, you can see total investment is 15. Investment in subsidiary company 5. Therefore, remaining is how much? 10. This was taken to consolidated accounts. This was taken to consolidated accounts. Okay. So there is no problem. What you need to do is you need to remove the other investment, right? As a practice, right? Now you can see parent investment is 5. Parent investment is 5. Net asset is 7. Net asset is 7. See, my arrow comes and knocks it off. Right. Now you have an excess. Now you have paid lesser, but you bought a higher price. You bought a higher value business at a lesser price. So the standard says the difference of 2000 is the profit of the parent. I have given in the balance sheet separately for you to understand the GBP. See GBP, part of profit of retainer, parents retainer. This is part, but I have given separately. See 5,000 minus 7,000, you bought the business 2,000. So that means the total profit of the parent is the addition of 3,000 plus 2,000. 3,000 is the profit I made plus 2,000 is the GBP. It should be 5,000. But I have given separately. I have given separately for you to understand. This is the profit. This is the GBP. Okay. This is the profit. This is the GBP. Okay. So PP is 15. Other investment is 10. No goodwill in this case. Why? We paid lesser. Current assets are 8,000. So 33,000. Right. Stated capital only from parent. Retained earning, you have two options. You can either put it as 5,000 or you can take it as 3,000, 2,000. But in the examination context, you need to take that as a 5,000 rupees because consolidated retained earning is the total profit, right? And liability is 5,000. So therefore, the total amounts to 33,000. So the variation. If you invest equal amount, no problem, line by line consolidation. If you invest higher amount, take that as a goodwill. If you invest a lower amount, you can take that as a GBP, right? Now, okay, you can see the summary of step number 1 to step number 3, right? Now you can see the summary of step number 1 to step number 3. Same example, but I have given option number 1 is 7,000. Option number 2 is 10,000. Option number 3 is 5,000, right? Now we look into a scenario where we can have all these options. Same question, right? But the investment we need to take alternative ways, right? Same question. We need to take the investment in the alternative way, right? Now you can see, right? PPE, no change. That is very important. See, even you invest 7,000, 10,000 or 5,000, line by line consolidation. I hope now it's very clear, line by line consolidation. Okay. Investment in others. First option, your total investment is 15 now, but you have taken 7,000. You have taken 7,000. So therefore it's 8,000, right? Therefore it's 8,000. Second option, your investment is 15,000. You have taken 10,000. So that is 5,000. Third option, your investment is, sorry, it should be 15,000 minus 7,000. So it should be, it is 5,000 is the 50. Yeah, it's a 5,000 investment, 15,000 investment. You have removed 5,000 rupees. So it should be 10,000 rupees, right? Okay. Now you can see how it evolves one by one. How it evolves one by one. Now I have given the arrow, right? Your investment is 7,000. You removed with the stated capital of 7,000. So therefore there is no problem. Therefore there is no problem. Both are removed. The balance is line by line consolidation. The balance is line by line consolidation. You removed your investment. You removed with the net assets. No adjustment, right? The second one you can see, you removed 10,000 with 7,000. So therefore there is a new item comes through the arrow. What is that? Goodwill 3,000. Goodwill 3,000. Okay, goodwill 3,000. What is the next option comes with? Your investment is 5,000. Your net assets are 7,000. The arrow says there is a profit of 2,000 rupees. There is a profit of 2,000 rupees, right? So you understood how the investment evolves over the period. And you pay more, there is a goodwill. You pay less, there is a GBP. The balance item you can see the PP, same 15,000. See the current asset, same 8,000. Stated capital is only from whom? The parent company. Retained earning is, in this case, it's same amount, right? Liability is also same amount. So it is line by line consolidation. This is line by line consolidation. But unfortunately, right, unfortunately, what is the change? If you make the same investment amount compared here, there is no goodwill. If you have an excess amount, there is a goodwill. If there is a shortfall amount, there is a GBP. There is a GBP. Okay. So this is the summary of approach 1 to approach 3. Right. Now the next question you will ask, sir, if I am buying a subsidiary which is in existence, if there is a profit or reserve, how we are going to adjust that profit or reserve, right? So that is the question. If we acquire an existing subsidiary company, we need to divide the profits or reserves of subsidiary into pre-profits and post-profits, right? We need to divide that into what? Pre-profits and post-profit. Why we need to divide that into pre and post-profit? See, the guideline explains clearly, any profit before the acquisition is pre. Any profit after the acquisition is post. That the guideline clearly explains. So you need to go to the subsidiary, you need to remove pre-profits and post-profits. See, what is pre-profit and why you need to see? These are the profit generated from previous shareholders' investment, because you are going to buy the company, previous shareholder had that one. So we need to buy the company belongs to the net asset. So we need to pay for that profit also. So accordingly, any pre-profits will be taken to goodwill calculation. Any pre-profits will be taken to goodwill calculation. So keep in mind, if you see the subsidiary, this is what the important, the acquisition date. You need to go to the acquisition date. Any profit prior to the date is pre, any profit after that is post. Clear? So therefore, you need to get it clearly. And you need to say, any profit generated prior to the acquisition, it is earned from someone. I need to buy that by giving the money. So that is, it says, accordingly, this will constitute the net asset at the date of acquisition. So therefore, this is the net asset you need to take for the goodwill calculation. Right? Now, the next one, see, post profit. These are the profit we earn after our investment. After our investment, we invested. So after our investment, it belongs to us. It's made of our profit. So accordingly, this constitute our profit, right? This constitute our profit. What we need to do is we need to add that profit with our profit. If it is a partially owned subsidiary, we need to take a prorated basis or sharing basis. But in this case, we are not doing, right? So therefore, keep in mind, you need to go to the subsidiary and say, any profit you had on the acquisition date, take it as pre. Any profit after acquisition date, take it as post. Pre-profit constitute your net assets. Post profit is the profit generated after the earn. So you can add it to your profit. It's like you earn your money. It's your money, right? You can add, right? So accordingly, I have given the same question, right? So maintain the consistency, right? So I have given the PPE, investments, current asset, stated capital, retained earning. Now you can see subsidiary had a retained earning of 2,000. Subsidiary had a retained earning of 2,000. Up to now we had zero balance. Now subsidiary had a retained earning of 2,000. And general reserve, parent has 5,000 and subsidiary had 2,000 rupees. Now there is a small problem. How we split the retained earning of subsidiary? How we split the general reserve of subsidiary? That's the rule. Any profit prior to the acquisition is pre. Any profit after the acquisition is post. That is the rule, right? And the liability. See, A acquired B investing 12,000 and own 100% of shares. At the date of the acquisition, retained earning and general reserve is 1,000 and 2,000. Make it very simple. Go to subsidiary company. Retained earning is 2,000. That is at the balance sheet date, right? This balance sheet, the SFP is as at 31st December 2018. Were given, right? So as at the date, the retained earning is 2,000. You acquire the subsidiary when 1st January 2018. From the 1st January 2018, you had 1,000 rupees. Now it became to 2,000 rupees. So 1,000 to become to 2,000. In the post period, you made 1,000 rupees profit. I hope you understood. You think about a hypothetical statement of changes in equity. Opening balance is 1000. Closing balance is 2000. Profit made for the year is how much? 1000 rupees. What profit? Post profit. Similarly, apply the concept of general reserve. Opening balance is 2000. Closing balance is 3000. Post period, what is the profit you made? 1000 rupees. Clear? Understood? So I hope you need to segregate the balance sheet profit into pre and post, right? So 2000 to be divided 1000 and 1000, 3000 to be divided 2000 and 1000. All the pre-profit goes to what? Goodwill calculation, right? So the question is given. Now we will see how to calculate the goodwill, and thereon we'll see the adjustments, right? Now I have given the goodwill. See how we get the goodwill. Now this is a overview of all the areas. Investment made by the parent is 12,000, right? Investment made by the parent is 12,000. Understood? It is a fully owned subsidiary, 100% owned, right? I said it's 100% owned, right? 100% owned, right? Okay. So no NCI or anything. So it's 12,000 rupees, right? So why I have given, if NCI comes, how to evolve with this, right? So it's 12,000. Net assets. We know stated capital is 7,000. Pre-retained earning is 1,000. Why? Given in the question. It's given in the question. And pre-general reserve, I have used the word other reserves. Both will have the same meaning, 2,000, right? So the net asset at the date of acquisition, see the word net assets is 10,000 now, right? Net asset is 10,000. Earlier it was 7,000. Now it is 10,000. So the net assets at the date of acquisition represent stated capital, pre-retained earnings. Net assets is 10,000 rupees. So therefore the goodwill is how much? 2,000 rupees. Now we will see what are the other workings or key accounts which is required in the exam, right? Now you go to the next slide, right? So I have given another emphasis. Goodwill is recorded as an intangible asset in the accounts, right? So that I have repeated that in all my slides for you to have an understanding, right? Now you can see these are the typical accounts you may prepare in your exam. A consolidated retained earning account to say the consolidated profit of the parent. How we start on? Parent's profit was 3,000. Parent's profit was 3,000. That is given in your balance sheet. Parent's profit was 3,000. Now see, pre-retained earning in subsidiary, post-retained earnings in subsidiary. Working number 1 and working number 2, right? We know given total profit was 2,000. Total profit was 2,000. Out of that, 1,000 is pre, right? 1,000 is pre. This pre was taken to what calculation? Goodwill calculation. Transferred to goodwill calculation. See, goodwill calculation. Goodwill calculation, right? Then the balance 1,000 is the post profit. It is allocated to parent. See, it's allocated to parent. Working number 2. See, so my profit is 3. My subsidiary profit is 1. So consolidated profit is 4. Consolidated profit is 4. So 2,000, 1,000 is pre, taken to goodwill, 1,000 is post, I added with my profits, right? Okay. As this slide is a very limited space, I have not given the timelines for you to see, but it is how you need to make, right? Similarly, right? See the general reserve, parent general reserve was 5,000. Subsidiary general reserve was 3,000. Out of that, 2,000 is pre-general reserve, where we have taken to the goodwill calculation, right? See, it is taken to goodwill calculation. Goodwill calculation, right? Goodwill calculation. Goodwill calculation, right? But the post-general reserve is added to our general reserve. See, our general reserve is 5,000. Post is 1,000. Therefore, the total is 6,000, right? You need to prepare T accounts like that, and you can take accordingly. So the cardinal rule is this: you need to prepare pre-post accounts of general reserves and retained. Pre-profits will be taken to goodwill calculation. Post-profit, if it is a fully owned subsidiary, will be taken to the parent, or we'll see evaluations, or we'll see some changes on the later with NCI, right? So I hope you understood how these adjustments comes, right? So we said This working is applicable for future questions wherever applicable, because with the time, with a limited space, we can't put all these adjustments. So you can refer always. This question evolves in the same way to understand the concept, right? Now, see the answer. PPE, parent 15, subsidiary 10, consolidated is 25. Investment. Total investment is 15. Investment by parent is 12. Therefore, it is 3. Therefore, it is 3. Therefore, it is 3. It goes to the consolidated account. Okay? Consolidated. Goodwill. What we do? 12,000 net assets. 7,000, 1,000, 2,000. So, therefore, the goodwill will be how much? 2,000. That is from our working number 1. We record this in only what account? Consolidated accounts. That is current assets 8,000 rupees. So the total is 38,000. Clear? Stated capital always from what account? Parent company. Right? You might ask, sir, what we do with? See the arrows comes up. Knocks off these. See, this is knocks off fully, because one assumption we make in our exam, stated capital will not change. Right? Because that is a very basic consolidated adjustment we do. So stated capital will not change. Right? So in the absence of any change, you will have the same amount. So your stated capital, as a rule, it will be the same. Right? So it has not changed. Right? Same. But this 2,000, see, I have given the working. 2,000, parent 3,000, 2,000 is subsidiary. We removed the 1,000. Why we removed? This is the pre-profit taken to the goodwill calculation. So therefore, the consolidated retained earning is 4,000. Similarly, the general reserve, parent is 5, subsidiary is 3, out of which pre is 2,000. Right? Therefore, it's 6,000. So you can see, I will show you the pre-accounts. See, 4,000 and 6,000. Adding the profit, post profits, right? Similarly here, 4,000 and 6,000. Right? Liabilities will be 5,000. Total will be 38,000. So what we did, right? We removed from the given profit all the pre-profits that is taken to the goodwill calculation, added the post profit with us, right? Added the post profit with us, right? So you need to do these workings, key accounts, so that you will be able to do one by one. Now, another problem what I have seen, right, might be in the exams or might be practical thing. Subsidiary make losses. Consolidation standard is very clear. It says even subsidiary make losses, you need to consolidate. Now, how we evaluate that? So if there is a loss-making subsidiary company, how we can do that? So I have inculcated the question into this, right? Same question, right? PPE given, investment given, current asset given, stated capital, retained earning, general reserve. Now see the adjustment. A acquired, B investing 15,000. Now we have made the full investment, right? 100%. At the date of at that date, the retained earning was 4,000. Now you wonder, the retained earning was 2,000. How we can get 4,000 rupees? Don't get panic. Imagine a statement of changes in equity. The opening balance was 4,000. The closing balance was 2,000. So if I ask question, what happened during that 1 year period? There is a post loss of 2,000. You had a profit of 4,000. Loss has 2,000. Therefore, there is a net reserve of 2,000 rupees. So be careful when you have this pre-post loss situation, right? So you can't say you can't do, because you can say, okay, if my closing is 2, if I have an opening of 4, during the period, negative loss of 2,000 rupees. That is clearly understood in this question, right? General reserve is same, and you need to prepare the balance sheet as a 31st December, right? So what happened when you are acquiring company's profit making? After you acquire, company has incurred a loss of 2,000 rupees. Now you can see how we get the goodwill, right? You can see how we can get the goodwill. 15,000. Stated capital is 7,000. Assume will not change. Retained earnings 4,000. Right? Pre-reserves 2,000. Goodwill is 2,000 rupees. Right? So see, this is very important. Retained earnings 4,000 rupees. Right? Now we'll see the workings. Right? Now see, retained earning brought forward in subsidiary company pre is 4,000, where it has taken to the goodwill account. Where it has taken to the goodwill. See, working number 1, working goodwill. But to tally to the 2,000 rupees in the post period, there is a loss of 2,000 rupees. The post period loss is allocated to the parent. Parent had a profit of 3. He absorbed the loss. Therefore, the profit comes as 1,000 rupees. The profit comes as 1,000 rupees. Very important, very cardinal, 1,000 rupees, right? Okay, general reserve, same variation, 2,000 rupees pre taken to goodwill, 1,000 rupees post that has taken to the parent, right? So what we have evaluated from this question or understood from this question is the very key rule. There is a pre-profit, there is a post loss. Post loss is absorbed by the parent. That is what the consolidation standard says. That's what earlier parent profit as 4,000 now becomes 1,000 rupees. So, right now we'll see the balance sheet, right? Okay, PPE 25,000. Investment, this has been gone because why? You can see the arrow comes in, right? It's knocks off. That's what it won't come, right? It's knocks off, right? So you see the goodwill, sorry, you see the goodwill. Goodwill is 15 minus this 13,000 odd. So therefore 2,000. Current asset 8,000. Therefore it's 35,000. Stated capital as a rule, always from parent come. Always from parent come. Retained earning, parent 3,000, subsidiary 2,000. But the pre-period, there was a profit of 4,000. So it converts the profit situation to loss situation. Therefore, you will have 1,000 rupees. Therefore, you will have 1,000. Okay. Therefore, you will have 1,000 rupees. The loss. So profit situation has gone into loss situation. General reserve was stood the same. Liability stood the same at 5,000 rupees. Right. So now under this variation, we had a pre-loss. Sorry, post-loss. Might be in the exam, you can have a pre-loss also, right? So be careful and prepare a working like statement of changes in equity. So you will be able to understand that it clearly formed, right? Right. So now up to step number 1 to step number 4, what we have studied. If investment is more line by, first thing we studied line by line consolidation, right? PPE, current asset, liabilities added line by line. Okay. We compared the investment, we compared with the net asset. If it is higher, goodwill, lower GBP. And we know pre-profits are taken to the goodwill calculation, post-profits are added with the parent. Up to now, the cardinal rule is bit clear, right? You just work out with the questions so that you will be able to understand the rationale of it, right? You need to understand the rationale of it. Apply the same rationale, the logic into the question. So you get the point, right? Now, the next variation is what? We generally don't buy subsidiary company 100%. Might be in the exam, it's possible, but might be practical. We might buy the subsidiary company 80%, right? That I said, to have the control voting right, you should have more than 50%, right? So therefore, you might not be essentially buying the company for 100%. If you buy the subsidiary company lesser than 100, there is another person who bridged the gap. Right? So we are going to say if a subsidiary is a partially owned subsidiary, what is the requirement? So step number 5, bit of a complexity now comes in. Non-controlling interest, right? Non-controlling interest. So that means if we own subsidiary lesser than 100%, right? Lesser than 100%, right? Now you can see my note. It is not essential for the parent to acquire 100% shares in subsidiary. Right? Parent may acquire subsidiary from a range of above 50 to 100 or lesser than 100, right? Below 100. So if we acquire below 100, what we say is partially owned subsidiary. So it's a partially owned subsidiary. So the subsidiary's net assets should be allocated to both the parent and another party called NCI, non-controlling interest. Okay, non-controlling interest. We are the controlling, they are the non-controlling interest, right? So what is non-controlling interest, right? So we need to allocate the net assets of subsidiary to NCI. Why? We own 80%. The other party owns 20%. So we need to allocate, right? Okay. So NCI means what? The amount of equity attributed to whom? Non-group shareholders, right? Non-group shareholders. That means outsiders represent. So that is known as NCI. So if you own a company 60%, if outsider owns 40%, that 40% is NCI. Why? It is parties or equity attributable other than who? Non-group shareholders, right? Now, how you calculate NCI? So in simplest format, NCI for your balance sheet, right? Share of net assets at the date of acquisition of NCI plus any post profit generated into their percentage. Why? Now the money you make is not only from you, it is partially from you. The rest remaining portion is from another person. Might be you will be going on a share vehicle, right? So you will be paying a small portion of fee, another person will pay the small portion of fee. Similarly, the business is run by two parties. You have some amount of capital, he has some amount of capital. You need to do the prorated of it, right? So don't worry, we'll see the variations of it bit later, right? So we take the share of net assets, see the word share of net assets of NCI plus post profit in subsidiary into NCI percentage, right? But don't worry, the consolidation technique will be the same, line by line consolidation, right? What is the difference if you calculate point number 6? If you calculate point number 6, right, you need to include this as an NCI in the balance sheet, right? You need to include the amount what you derive from point number 6 in your balance sheet. Where you represent, you can see in point number 9, NCI is a part of an equity. You need to put below the equity, right? But separately from parents' equity. You have our equity, you have non-group shareholders' equity, you will have the total equity. Clear? So if you own a subsidiary lesser than 100%, you need to take the NCI. Right? Now the problem comes. Standard gives you a lot of variation in measuring NCI. So as per the standard, NCI can be measured either at the percentage of net assets method or fair value method, right? Might be you can, in your exam, you have one subsidiary, but in practical, you will have a lot of subsidiaries. So it's given on item by item, investment by investment option, right? So now the problem, what method we apply? Net assets method or fair value method, right? How you determine NCI, right? So the question, the note says percentage of net assets means, right? What is the percentage? Under this method, we will allocate share of net asset at the date of acquisition. So what we do is we go to the balance sheet of subsidiary on the date of acquisition. We take stated capital and all the pre-reserve. We prorate it. We prorate it, right? We prorate it and say this is for the parent, this is for the NCI, right? This will be taken for the goodwill calculation. Why? Because standard want us to take the full investment compared with full net assets. So therefore, I let you know how to do in the question basis, right? So it will be taken to the goodwill calculation, right? So we need to match it on the goodwill calculation so that we can take the holistic view, right? So then, or after that, then the post profit generated by subsidiary, you need to take the share and take that into the balance sheet. See, then the post profit generated by subsidiary should be allocated to NCI to derive the NCI for the balance sheet, for the SFE, balance for the SFE purpose, statement of financial position. I'll be subject to any adjustment, so we are not doing any adjustment. So what you need to do is go on the acquisition date, find out NCI, and go after the acquisition, take the post profit, add the share. See NCI, how you get it? Acquisition date net assets into NCI percentage, post profit in subsidiary into NCI percentage. This is based on the book values. This is based on the book values. You get it, right? We'll do an illustration to see how we will get it. Fair value method, right? Under the fair value method, under this method, fair value should be calculated. You need to find out value. Generally, there is an option given in the exam. You will be given number of shares in subsidiary company. You have NCI percentage, you will be given market value. So take number of shares into NCI percentage into market value. You can get NCI. Or the examiner will give you, this is the fair value of NCI at the date of acquisition. Okay, so this should be taken to the goodwill calculation. Why? Standard won't have a two-way matching. Take the total investment, total net asset. But only this, right? Only this fair value, you will be given a number. You will be given a number. What you need to do is, once the amount is given, same step. What do you need to do? Go to the post profit generated in subsidiary, take the NCA percentage, add to them. That will be the amount for the balance sheet purposes. So I see NCI, you are given with the fair value. You are given with the fair value. You take the post profit in subsidiary and take the percentage. Here it's based on the given net assets. Here it's based on the fair value, right? So the method is same. Once you got this amount, you need to put separately in the equity after parent's equity, right? Now we'll see a small question, how it evolves, right? Same method, same question. See the adjustment. A acquired B 7,500 investment and own 75% of shares. 75% of shares, right? On 1st January 2008. Retained earnings are given at the date of acquisition. Statement of financial position were required to prepare. What method? Under the both of the methods. So I said, if it is both method, fair value of NCI should be given for the fair value, right? In this one, I have done a small matching, so you can understand the matching, how it happens later when you do the question, right? So the matching says NCI under the fair value method is 2005. Okay, right? So now don't panic. We'll go to the question. We'll fix on the figures. So just have an eye on the investment. 7,500 is the investment value. Clear? Right. Okay. Right. Now see, right, how to calculate the goodwill. Right. Parent has an investment of 7,500, which represent 75%. Which represent 75%. Right. See, it represents 75. Okay, it represents 75%. Okay, right. But you need to have 100% investment. What you did? NCI, you got 2,500. How you got 2,500? See here, the net asset at the date of acquisition. The net asset at the date of acquisition is 10,000. Net assets at the date of acquisition is 10,000. Right. So what you did, right? You have taken 25% of 10,000. You are given 25% of 10,000. Okay, the arrow shows 25% of 10,000. So this represents 100% of investment. 75% of investment 7,500, and you got the net asset 10,000. So you got 25%. Right. So the arrow shows from the 10,000 you got 25%. Right. So 10,000. So unfortunately no goodwill. Purposely I did no goodwill, because there will be some difference in this valuation method. Later we'll understand, right? Okay. But this 2,500, I hypothetically calculated and given this 2,500, right? I want to make it the same amount, so you don't see a impact of it, right? So this is, if it is fair value, don't worry, it will be given, or you will be given information to calculate, right? Okay, 7,500, 2,500, 10,000. So you compare with that, you will have a goodwill of 10,000, right? Okay. Now, what is the problem? So I hope you understood the goodwill calculation. Now, what is the problem? I said, now you know, under both the method, the NCI was 2,500. This is at the date of acquisition, but you need to take the balance sheet date. So we'll go to the question. What the question says? See, this is 1st January 2000. But you need to prepare the balance sheet 31st December 2000. So what you need to do is, you have taken, this is 1st January. Okay, you need to take 31st month. What you need to do is, you need to add the post share of profits. Okay, post share of profits. See, parent has a profit of 3,000. Subsidiary had a post profit of 1,000. I hope you can remember from the previous workings, we had 1,000. But We are not taking fully. We are taking 75%, which is 750, 3,750, right? Similarly, consolidated other reserve, 5,000 post, you can remember it is 1,000 we had. We take 75%, 7,750. So earlier instead of 4, we got 3,750. Instead of 6, we got 5,750. What happened for the balance 250s? Each that is added to NCA. See, NCA and both methods are same. You give post share of profit. I mixed it with my explanation. Give calculated net asset basis NCI, given fair value NCI, allocate post share of profit. Allocate post share of profit. So you will get 3,000 rupees. You will get 3,000 rupees. So compare, right? Okay. Investment, what happens? Right? So PPE, I hope you can have the same answer, 25. Investment, 15,000 minus 7,500. So you had 7,500. Goodwill under both of the scenarios, 0. Current asset you had. So you had the same net asset, total asset. Stated capital always from parent, right? Retained earning or consolidated retained earning, you can see this is the parent 3,000. Subsidiary 1,000, but we take 75%. Okay, so that is 3,000, right? Parent other reserve 5,000, but we take subsidiary 1,000, but we take what percentage? 75%, right? So why we take 75%? Because the belongings only comes to me. That's what I said previously. We take post profit after giving to NCI in my previous slides, right? So we need to take only our share. So NCI given value or 25% of 10,000, then post profit 3,000. So the balance sheet balances. Right now, you wonder, this gives you the same basis, right? But generally, what happens if you go for the fair value basis? Sometimes the NCI value will be higher than the book value, right? So that is the next step what we are going to do, right? I hope that you can understand now how the NCI works, right? So we can see the next one, how the NCI will have an impact, right? So you can see based on the measurement of NCI, the goodwill amount will be varied. That is the problem, right? Why? Percentage net assets equal to the book value, therefore no goodwill, right? So under the percentage net asset method, we calculate goodwill to the parent extent. So this is known as partial goodwill method, right? This is the partial goodwill. We calculate for the acquisition part. But under the fair value method, right, the goodwill is calculated for the business, the combined. So this is called as what method? Full goodwill method, right? Full goodwill method. Now the problem comes, first option you calculate for parent, second option you calculated for parent and NCI, right? So in the fair value, the goodwill is, you can't attribute it separately, but the goodwill comes for both of them, right? So keep in mind in the exam, right, I have emphasized fair value will be given for you, right? Don't panic. Or you will be given details to calculate. If details are given, you need to take the number of shares, multiply by NCI percentage and get the market value, multiply market. So you get the at the date of acquisition, what is the value. Now I have given now a small variation of the question, which explains same balance sheet, right? Same balance sheet. So that's why I'm not repeating the balance sheet. You need to see the adjustment, how it get fixed in, right? So what it says, we invested 10,000 rupees to acquire 75% of shares. Pre-post profit, I maintain it very uniformly, right? And prepare the balance sheet after 1 year under both methods. Now see here, the non-controlling interest under the fair value method is 3,500. This is what happens in the exam. It will be given, right? Now, as you know, the previous one to the current one, we'll see how it changed, right? How it changed. Right. Now you see the goodwill calculation. Now parent investment is 10,000, both of the players, which represent 25%. This is why we know we want to take the 100%, right? That's what we think. First 75%, right? 10,000. Under the percentage net asset method, I explained, you take the net asset, which is 10,000, apply 25%, you will get 2,500. You will get 2,000. So the total value is 12,500. Net asset is 10,000, so the goodwill is 2,500. this goodwill is parent's goodwill. This goodwill is parent's goodwill. Why? Because if you take 75% or 25% of this, that equals to this. So there is no goodwill come for NC, right? So it is the parent's goodwill, right? But under the fair value method, you take the same net assets, you take the same investment. 3,500 was given. Can remember 3,500 was given. You need to put that. This is the value we derived. There are a lot of valuation, we derived the value. So therefore, the goodwill is 3,500. Now I want you to concentrate this slide very carefully. See, the goodwill has increased by 1,000. See, this 1,000 increment in goodwill under the fair value method is due to the increase in NCI. So I want to make a point. You see this slide very carefully. The NCI was increased by 1,000. The goodwill was increased by 1,000. So we say this is the total goodwill. So 3,500 is the total goodwill, which is attributable for both. 2,500 is the parent. Clear? So therefore, if NCI is measured at fair value, there will be an impact of goodwill. There is an impact to the goodwill. So I hope you understood that. And I need to see the variation in the balance sheet, right? So I have given the workings, same way of doing it, right? You take parent's profit, apply 1,000 into 75%, 3,000, right? And you take other way around, parent profit is 5,000, 75% is 700, sorry, 75% of 1,000, 750, 5,750. I made it uniform so that you can see the previous example and get it, and only see the relevant stuff under this line, right? Relevant stuff. Now you see the NCI. Net asset based NCI is 2,500. Fair value based NCI is 3,500. We allocated same basis of post profit. So the NCI was under the percentage net asset method 3,000. Under the fair value method, it is 4,000. So the increase in NCI has resulted increase in goodwill in this line. Goodwill has increased by 1,000. Under this method, NCI has increased by 1,000. So you need to understand, examiner says fair value. Examiner says fair value. The goodwill is a combined or full goodwill method, right? So it's a full goodwill method. Now you can see the balance sheet, right? Now see, same PPE, same investments, right? So the topic is, see, consolidated under the net assets, consolidated under the fair value. See, PP is same, investment is same, goodwill is 1,000, increased by 1,000, right? Goodwill increased by 1,000. That is the variation. Current asset is same, total asset increased by 1,000. The rest of the items are same except the NCI had an increment of 1,000. So that means if you have an NCI under the fair value method, automatically it might lead to full goodwill method. If it leads to full goodwill method, next adjustment, number 6, will have an impact and a bearing. That is the problem. So keep in mind, percentage of net assets means parent's goodwill. Fair value method means full goodwill. NCI is a party to that goodwill, right? We can't distinguish, but he is a party to that goodwill. So almost, I want you to see the variation in the slide. So almost the previous example to the current example were the same, but here goodwill has changed, NCI has changed. Why? Under the fair value method, NCI had a higher value, therefore the goodwill has changed, right? Now step number 6, which is very important, impairment. We know there are 2 goodwill comes in, right? There are 2 goodwill comes in. Based on the goodwill, impairment will have a bearing, right? Now, just give a small idea about what is impairment, right? Impairment is an expense, right? SLFRS and LKS requires goodwill should be tested for impairment annually, right? So there are standards LKS 36 in your syllabus. So it wants you to test the impairment, goodwill impairment annually, right? So you might ask, what is that? How you record? It's something similar in simplicity, like a depreciation expenses you provide. Not technically, not is depreciation, right? That I want to emphasize. Technically, it's not depreciation. Accounting wise, you can say like a depreciation. What do? Credit the assets, debit the profits, Credit the assets, debit the profit. Simpler double entry, right? You credit the accumulated depreciation, debit the profit. Simpler that, like that, you put a double entry, right? Okay, right. So the important thing is, once they impaired the goodwill, it is irreversible. You can't reverse the goodwill, right? Based on the measurement of NCI, the accounting for the goodwill is changed. That is very cardinal. Under percentage net asset method, goodwill is for the parent. So any impairment, you need to understand. Fair value method, goodwill is for both. Total. Then how it affects, right? That is the cardinal rule. So we'll see in the next slides how these variations come up with, right? So you can see my next slide 6. I have given in the full understanding what is this impairment. Based on the measurement of NCI, the impairment of goodwill will vary. Okay, percentage net assessment. Under the method, goodwill is calculated to the extent of whom? Parent. This is known as partial goodwill method. If it is a partial goodwill, what do you need to do? Charge the entire impairment to the parent. What do you do? Debit consolidated retained earnings, credit the goodwill. Charge entire loss to the parent. Debit profit and loss of parent, credit to the goodwill. But if it is a fair value method, under this method, goodwill is calculated for the both. Goodwill is calculated for both. So if it is both for both, you need to prorate it 70-20, 70-30, 80-20, 90-10, 60-40, like that. You need to prorate the loss. Why? Both parties has a loss, right? See, therefore impairment should be, therefore interest charge to parent and NCI proportionately. What do you do? Debit consolidated retained earnings to the parent portion, debit NCI for the NCI portion, and credit the goodwill. Right now, why the first method? First method is parent goodwill, depreciation for parent, like that. This is parent and NCI, loss for both, prorated. But in the exam, what you can do is, you can charge this against post profit and subsidiary. Post profit is redistributed, so therefore it will get affected, right? So you need not to charge for both, but what you can do is, you can credit the goodwill, debit the post profit in subsidiary, so it will get reallocated for both of the parties, right? Now we'll see another small example, right? Same thing has been given. So this is specifically focusing on percentage of net assets method, percentage of net assets method, right? Okay, so the figures wise all are the same, right? Figures wise everything is same, and I have stressed, right, if NCI is measured at the percentage of net asset method, and I have given another adjustment. Impairment of goodwill is 500. So what happens if this impairment comes? You need to charge this against parents' profits. Debit to consolidated retained earnings, search and debit there, credit to the goodwill, right? Okay, now we'll see how we calculate the goodwill, right? 10,000 was the investment, net asset in subsidiary is 10,000, 25% belongings 2,500. Keep in mind, right? So 12,500, net asset is 10,000, goodwill is 2,000. So if this goodwill impairs 2,500, credit the goodwill. So goodwill becomes 2,000, right? Goodwill becomes 2,000, right? Okay, see, right? So I have given a point to stress. Goodwill is taken as an intangible asset. Now see, right? Okay, I'll put all these on populated, right? Now see, here it's very important. Consolidated retained earning. You can remember from previous, you had 3,000, you had 75% of 1,000, but here new item comes as impairment of goodwill 500. So that it became 3,250. So what is the double entry? Goodwill credit became 2,000, debit to consolidated retained earnings. 3,750 became 3,250. That is the impact. Rest of the item is same. See here 5,750, 3,000 there, right? So what I did, right? What I did, you can see the balance sheet, right? Before the impairment, and I have given after the impairment, right? That is the scenario, right? Before the impairment and after the impairment. You can see PPE, same. Investment in other companies, right? So we have removed B. So investment in other companies, 5,000, right? Goodwill, 10,000, 7,500. I had taken parents portion, so it became 2,500. Here I have given before the impairment 2,000. See, I have credited the goodwill here. I have credited the goodwill, so it became 2,000. So see, because of impairment, goodwill has come down by 500. Goodwill has come down by 500. Current asset is same, stated capital is same. See the retained earning. Before the impairment 3,750, after the impairment 3,250, 3,250. See, 3,000, 1,000, 75% minus 500. I want you to understand this 500. What is the double entry? Goodwill credit, retained earning of parent debit, right? So you can see the difference. I have credited the goodwill, debited the consolidated return. So that the balance will be line by line. So once you get the goodwill, credit the goodwill, debit consolidated. So debit consolidated is here. Debit consolidated, right? So under the percentage net asset method, the goodwill impairment is only applicable to the parent. The double entry is credit goodwill, debit the consolidated return. Same thing, same question. I have done a small variation, right? I have done a variation. What I did was, see adjustment number 3, the amounts are given, but the NCI to be measured at the fair value. NCI to be measured at what value? The fair value. And the fair value of NCI is 3,500, right? Same previous question. Right, you know the goodwill and all upfront, so you can see my slide, you can derive it, right? 3,500. But the impairment of goodwill is 500. Now there is a small problem, right? Now you own 75%, NCI own 25%. Fair value method, NCI should absorb the loss. Why? NCI has absorbed the goodwill, they need to suffer the loss, right? That is the cardinal rule, right? Now you can see the goodwill, same answer, 10,000. This is generally given 3,500. You got 13,500. Goodwill is 3,000, right? Next slide is very important. See the next slide. Right. Parent retained earning is 3,000. Subsidiary share of profit 75 is 750. Impairment prorated 500. My loss 75%, 375. That is my loss. So therefore my profit is 3,370, right? General reserve will not vary. See the NCI now. NCI 3,500, 250, 250, 125. Why you say 125? 125 comes NCI absorb the loss of impairment. Why? He has taken not net assets, he has taken fair value. As he has taken fair value 3,500, he has a goodwill. He need to absorb the loss 125. So in the previous it was 4,000, now it became to 375. This is option number 1, students, right? This is option number 1. But in the exam, ideally I will do like this, right? What I did, right? Right, let me to pop it out here, right? So I will prepare a post profit account, right? So the total profit of the subsidiary is 2,000. You can concentrate post profit. The total profit in subsidiary is 2,000. Pre profit is 1,000. So therefore you will get post profit for the period is 1,000, right? And I deduct the impairment. What is the double entry? Post profit credit. Sorry, post profit debit, goodwill credit. Post profit debit, goodwill credit. So profit for allocation now drops to not 1,500. When you reallocate 375, 125. So automatically the loss has been prorated and added thereon. Now you see here the previous one, option number 1, we took 750, 375, right? Here we took 250, 125. Net impact, see the net impact, 375 and 125. So here, I prefer personally, you can debit the post profit credit the goodwill, reallocate so you don't miss in the exam, right? So might be you can keep that as a practice to do. So this method, option number 2, will be easier and helpful in the exam to see how it happens. See, post given profit is 2, pre-profit taken the goodwill 1000, impairment is 500, profit for allocation will be 1000, right? So this is the major complicated part in relation to the consolidated accounts, right? Right now, you the variation in their balance sheets, right? You can see the variation. Goodwill before the impairment 3,500, after the impairment 3,000. So the impairment is how much? 500. But the absorption of impairment, parent 75%, NCI 25%. So you can see 3,000, 1,000 into 75 minus 375. What is that? Impairment. 3,500, 250, 250 minus 125, that is the impairment. You can see before the impairment, parent 3,750 became 3,375. After the impairment, sorry, yeah, so before the impairment, 3,750 became 3,375 after the impairment. NCI before the impairment, 4,000 became 3,870. So that means the loss has been prorated to the parent and NCI, my dear students, right? So I hope I have explained fair value method. Both party will absorb the impairment. Under the percentage net assets method, only the parent will absorb. So as a summary, I want to remind you again, right? You can see based on the NCI, goodwill impairment will vary. If it is percentage net asset method, this is the double entry, right? What is the double entry? Consolidated retained earning debit, goodwill credit. Why? Parents portion, right? So you need to search and pass the double entry. But under the fair value method, what is the double entry? You need to debit parent portion, you need to debit NCI portion, you need to credit the goodwill total, not the portion total, right? So therefore, under the fair value method, you need to prorate. You can charge to their account directly, or you can charge to post profit directly. That is the easiest method which comes up with. Right, finally, right, as a step number 7, right, as a finally, what you do for any intercompany receivables and payments. What you do for any intercompany receivable payment. What the consolidation standard says, you don't have a company called A, you don't have a company called B, you have a company called A group. So what happens in intercompany receivable payable? A will give some money to B, B will give some money to A. Both party will record assets and liabilities, right? So in consolidated accounts, when you prepare, you don't have two entities, right? You don't have two entities. Without having two entities, you can't enforce the payment, right? So that is the rule. As discussed, the group is what? Single unit, economic unit. Having the intercompany balances, we will see bubble the assets and liabilities. You have an asset, you have a liability, but you won't pay and receive. Individually might, but in consolidation, you can't enforce it because it's one company and finally, right? Okay. So we can't enforce the payable against receivable from the same party, right? You can't, right? Because it's the same party. No point in paying and receiving because the resources will not change. Do you got my point? If it is same party, one party pays the cash, other party receives the cash. No changes in the resources. So it's just bubbling the assets and liabilities, right? Accordingly, SLFRS 10 requires us to eliminate intercompany receivables and payable in the group accounts in full, right? In full. If there is any difference, we'll talk about it a bit later, not now. So in full. So what will be the assets and liabilities? Any receivable payable represent outside the group will be reflected. Okay, outside the group will be reflected. So intercompany balances may arise due to trading or advancing or anything from parent to subsidiary or vice versa, right? So example of intercompany I have seen from the exam: trade debtors, trade payables, current account receivable, current account payable, loan receivable, loan payable, interest, other receivable, other payables, or anything. So if you see these amounts, what you need to do is you need to remove the receivables against the payable. Why? You remove the assets by that amount, you remove the liabilities by that amount, balance sheet will not get distorted. Why? Because no changes in the resources, right? What do you need to do? remove that amount, eliminate the amount, right? Now we'll go for another variation of the question, right, for intercompany to address. Now you can see same balance sheet, I have maintained the uniformity. Now I have given a specifically here, current account with B in A's books. Current account with B in A's books, right? Okay. And see, current account with B in A's books, current account with A in B's books. So B want to pay to A. That's what B says. I owe A Limited. What they say is I want to receive from A Limited. So current account with B Limited in A Limited's books represent 2,000. Current account with A Limited in B Limited's books represent 2,000. Now you have receivable 2,000, payable 2,000. When you combine, hypothetically, you will have a current asset, current liability. Single person receiving and paying will not change the resources. That's what the logic of SLFRS 10. Right? You have an asset, you have a liability. Even though you pay and receive will not make a sense. Right? Okay. And now you can see, so this is one point of view I have explained you, right? See the adjustment, same adjustment I have given first one, same adjustment I have given the second one, same adjustment I have given the third one, and I have maintained because I prefer to explain the fair value method. That's what I want to explain. I prefer to explain fair. Sixth one, see, in addition to the current accounts, there is a short-term loan of 500 in current assets. So this current asset of parent has 3,000 having a 500 rupees intercount, right? And current liability, there is a current liability also. So B Limited current liability has what? 3,000 rupees. So in addition to current accounts, A has granted a loan to B, right? A has granted a short-term loan to B. So A says current asset, B says current liability. You can see in the past question, short-term loan. What do you do? Eliminate the balance, right? Eliminate the balance. So keep in mind, in addition to current account, there is a current asset and current liabilities as what? Intercompany item. So what is the adjustment? Elimination, right? We'll take you through the same example, right? Okay, you have investment, you have fair value of NCI, you have net assets, the goodwill is 3,500. Same example, I have not changed, right? Okay, sorry. Right, I have taken this. So the what you call is goodwill is after doing the NCI adjustment, after doing the impairment adjustment, 3,375. Consolidated retained earnings after doing impairment, 3,370. Consolidated retained earnings, consolidated other reserves, that is the general reserve, 5,750. NCI 3,875. You can see the post profit. I prefer, that's why I said I prefer to do in this basis. Post profit is 2,000. Total profit is 2,000. Pre profit is 1,000. Impairment has removed 500. Profit for allocation 500. 25% is 75%. That's how you got 3,375 and 3,875. So this is, I maintain uniform because you can see all these adjustments from the previous one. What I want to make you understand, right, is the intercompany. Now, PP is 25,000, investment 5,000, goodwill 3,000 after impairment of 500. Current assets, see, parent 3,000, subsidiary 7,000, intercompany removed 500. So therefore 9,500. Why? There is an intercompany receivable. Immediately look into current liabilities or liabilities. Parent 4,000, subsidiary 3,000, minus 500. Therefore liabilities are 6,500. Now see, eliminate the same receivable against same payable in full, right? Similar, current accounts 2,000 receivable won't come. Why? No outside liabilities or asset. Here, outside is not 10, 9,500. Here, no outside. You got my point. I said only the consolidated account represent outside items. Here, outside is 9,500. Inside, nothing current assets, right? Nothing current accounts, right? Similarly, stated capital you have taken, retained earning, general reserve, non-controlling interest. Liabilities 6,500. What is 6,500? Liability is payable to outsiders. And current accounts 0. Current account 0. Why? That does not represent assets and liabilities outside the group. Intercompany. Eliminate. So only represent is 9,500 and 6,500. So okay, students. Now what we have done, we have come to the final part of the session, right? So I have done my step 1 to step number 7 in a very short period, taking through one example. I have given you the logic, how it changes, so that you get the logic, so you can prepare the past papers. The objective of getting one question and evaluate or evolving with that question, right, is to understand the logic and how these logics will affect individual item, not comprehensive, not as multiple item, because it will be very difficult to explain at a very shorter time to have a much greater impact. Right now we'll demonstrate and see. Bear with me a couple of minutes to demonstrate and see some of the past paper questions, so that we can understand what kind of a understanding we had in this regard. Right now, say it's a past paper question from a recent paper. G acquired 70% of shares in B. So this is the parent company. Control is their 70% in the subsidiary company. On 1st January 2016 for an investment of 12 million. Underline that word. That is the investment made by the parent, which represents 70%. The fair value of assets and liabilities were same. And the fair value of NCI is 3 million rupees. Now you need to understand, I said the fair value will be given to you students. So the total investment is parent investment 12,000, NCI investment 3,000. So therefore the total investment to represent 100% is 15,000. Right? See, stated capital 7,000. So you can remember. So I have taken a similar amount for you to absorb this question. So my objective is whether you can face the exam with confidence. Right? See, so stated capital is 7,000. Right? Stated capital is 7,000. Reserve, general reserve 1,800. Retained earnings. See this one. At the date of acquisition, that is very important. At the date of acquisition. So calculate the goodwill of how many marks? 5 marks to it. So this is very important in your exam, right? So you can see I have given the answer. Investment made by the parent 12, NCI given by the examiner 3, goodwill, a total investment is 50, right? Stated capital 7, pre-retained earning 2, pre-other reserves 1,800. Therefore the goodwill is 4,200, my dear student. So this is one of a past paper question which I have taken as my model to do the question over the P, right? Next one, there is another past paper question that is also a very recent question, right? Okay, on 1st April 2018, Sigma PLC acquired 75% of Beta PLC, parent company, 75% of subsidiary company, 1 million shares, right? Underline the word 1 million shares. See, the word is very tricky. 75% of Beta's 1 million shares. So Beta had a share of 1 million. Okay, you have taken 75%. That means the 25% is NCI, right? Okay, for 290 million. Clear? On the date, the fair value of identifiable assets of Beta is 340 million. Very simple one. You have given the net asset value 340 million. You have given 75% of investment value 290, right? See, this is a tricky point, right? The market value of the shares at the date of the acquisition of Beta was 365. What triggers you? I told you, examiner will give you number of shares in NCI, sorry, subsidiary, 1 million. NCI percentage, 25 students, 25. 1 million into 25, 250,000 shares. What is the market value? 365 per share, right? Per share, market value of a share, right? Per share. So that you can do the maths, it will be around something around 90 million, not approximately. So what you need to do is, you can take the investment 290, you need to do the maths to get the NCI, 1 million shares, 25%, 360. and compare with the net assets given. Now I have done the comparison, right? Investment 290, my maths, 1 million shares, 25%, 365, 91 250, 381 250. Net assets 340, right? So the total assets, I maintain a rule, total assets, because SLFRS 3 want to do something like this so that you can compare. So total investment, not asset, total investment 381, net asset is 340, therefore the goodwill is 41 250 million thousands, right? 41 million 250,000. So students, what we did by and large as a model to see the variation in taking a partially owned subsidiary, okay, partially owned subsidiary with pre-post profit adjustment and any impairment, right? Impairment also was not in this any questions which I have selected, but over the period it will be tested, right? So therefore, with that I will complete my first part of the session. Thank you very much. So I will hand over the floor to the AAT to do the.
We hope you have gathered very good understanding about the roots of the consolidations and the basic adjustments you find there. I take this opportunity to thank Mr. Mohammed Nasir on behalf of AAT Sri Lanka for accepting our invitation and spending your valuable time. It's almost 2 hours from your valuable time doing the presentation for our students. Once again, I thank the lecturer and students for joining on this fruitful initiative. Dear students, there'll be more seminars down the line, so make the most out of it. Thank you. Stay tuned, stay safe. Have a pleasant day.